For decades, owning a home in Florida was the ultimate achievement of the American dream. You saved for years, signed the 30-year mortgage, and built your family's future under the sunshine. But today, that dream is rapidly transforming into a financial prison. Millions of middle-class homeowners across the state are waking up to a terrifying reality. Their homes are not just losing value, they are becoming completely unsellable. And it's not because people don't want to live here anymore. It's because the global financial system has quietly decided to pull the plug, trapping regular families in a crisis they cannot escape. And this is where things get ugly. Take a look at Cape Coral, Florida. Beautiful waterfront properties, miles of canals, and master-planned suburbs. From the outside, it looks like paradise. But on the ground, homeowners are trapped in a golden cage. Imagine receiving a notice from your property insurance company stating that your premium for the year is now $12,000. That isn't a typo. That is the actual reality for thousands of working-class families in 2026. The national media loves to talk about Florida's red-hot real estate market and surging population. But they completely ignore the families who are skipping meals or draining their retirement accounts just to pay for a piece of paper that keeps them legal. Of course, not every area in Florida is collapsing equally, and some landlocked counties are managing to avoid these extreme numbers for now. But for the vast majority of single-family homes near the coast, the economic ceiling is crashing down. Why are major insurance giants, companies that made billions of dollars in Florida for generations, suddenly packing their bags in the middle of the night? The corporate executives blame climate risk and unpredictable weather patterns. But here's the part nobody talks about. It's a pure Wall Street calculation. Due to the skyrocketing costs of building materials and labor, rebuilding a home after a storm now costs 35% more than it did just a few years ago. At the same time, global reinsurance firms in Europe raised their prices, making it unprofitable for domestic insurers to stay. The headlines say these companies are reacting to natural disasters, but the reality on the ground is that they are leaving to protect their stock prices and corporate bonuses. Do you think it's fair for these multi-billion-dollar financial institutions to abandon regular citizens the moment the risk becomes real? Naturally, from a purely capitalistic standpoint, an insurance company cannot operate at a continuous loss without facing bankruptcy. But their corporate survival is creating a massive standoff with the banking industry. This is where the trap snaps shut. Many homeowners think, if insurance is too expensive, I'll just drop the policy and take my chances. But if you have a mortgage, the system will not allow you to do that. Over 60% of homes in Florida are financed through a bank, and federal lending laws require active hazard insurance to protect the loan. If your insurance company drops you and you cannot find a replacement, the bank will step in with force-placed insurance. This is a worst-case scenario. Force-placed insurance is often 3 to 4 times more expensive than a standard policy, and it offers zero protection for your personal belongings. If you cannot afford this new, inflated monthly payment, the bank will immediately start the foreclosure process and take your home. The mainstream narrative tells you that a 30-year mortgage is the safest way to build wealth. But right now, it is a legal trap, locking people into bankruptcy. What would you do if your monthly housing expense suddenly increased by $1,500 with no way out? Granted, wealthy buyers who paid cash for their properties are completely immune to this banking leverage. But for the average family living paycheck to paycheck, this pressure is forcing them into an involuntary migration. Florida was built on the promise of an affordable, tax-friendly retirement for the working class. But that promise is officially dead. We are now witnessing the birth of a new demographic: financial climate refugees. Data from the Census Bureau is revealing a quiet, steady exodus of middle-class Americans leaving the state. They are selling their homes at a loss and moving to Georgia, Tennessee, or the Midwest. The media highlights the wealthy executives moving to Miami with cash, but they hide the families who have lived here for generations being forced out by fixed expenses. The dream of spending your golden years by the beach is being replaced by the basic struggle for economic survival. Do you believe Florida will eventually become an exclusive playground reserved only for the ultra-rich and corporate landlords? Obviously, shifts in population are a natural part of economic cycles, and some metropolitan areas continue to create new jobs. However, the departure of the middle class is leaving a massive scar on the local housing market. If you think this crisis is limited to single-family homes on the coast, you need to look inside the high-rise condo buildings. Condo owners across Florida are experiencing a catastrophic explosion in their HOA fees. Following new structural safety laws, building associations are forcing residents to pay massive special assessments to repair aging concrete and fund building insurance. Monthly HOA fees are jumping from $400 to over $1,500 a month in older buildings. On paper, these oceanfront condos look luxurious and secure. But in reality, elderly residents living on a fixed Social Security income are being driven into financial ruin because their condo fees now exceed their entire monthly income. How would you react if your building association handed you a surprise $50,000 bill due in 90 days? To be fair, some well-managed buildings with healthy reserve funds are handling these structural mandates without destroying their residents' finances. But for the vast majority of older complexes, this wave of expenses is wiping out the value of the property completely. This brings us to the core of the housing trap. Your home becomes an unsellable asset. When you list your home on Zillow or Redfin today, smart buyers look at more than just the mortgage. They look at the insurance history. If a buyer realizes that a property is located in an uninsurable zone, their traditional bank will instantly deny their loan application. This means you can no longer sell your home to 90% of the population. Your pool of buyers shrinks to cash-rich corporate investors who will only buy your property for pennies on the dollar. The public narrative always assumed that real estate is a safe liquid asset that will always find a buyer. But the reality on the ground is that an asset you cannot insure is an asset you cannot sell. If a home was marked down by 40%, would you take the gamble and buy a piece of uninsurable real estate in Florida right now? Of course, institutional cash buyers are still snatching up land in premium locations, looking at the long-term value of the geography. But for a middle-class family whose entire net worth is tied up in their home equity, this freeze is absolutely devastating. What is happening inside Florida right now is not an isolated incident. It is the blueprint for an unaffordable America. The exact same financial mechanics are currently playing out in the wildfire zones of California, the hail alleys of Texas, and the floodplains of Louisiana. The global insurance and banking systems are quietly rewriting the rules of property ownership across the United States. The politicians call it a temporary market correction, but the data points to a massive structural collapse of housing affordability.